the world's safest investment just crossed an invisible line. America's national debt now towers past $38 trillion, fueling global headlines and sudden panic in bond markets as foreign buyers quietly retreat. If trust evaporates and everyone stops buying U.S. debt, the financial backbone of the modern world could buckle overnight. How did an unbreakable system become so fragile? And what comes next when the world's lender of last resort faces a crisis of confidence? In the aftermath of the 2008 financial crisis, the world's largest economies faced a reckoning. Trust in private banks had evaporated, but U.S. Treasury securities offered something no other asset could: the full faith and credit of the United States government. Central banks from Beijing to Berlin poured reserves into treasuries, drawn by the promise of safety and unmatched liquidity. At the heart of this new order stood the Federal Reserve. Over the next decade, the Federal Reserve expanded its balance sheet by nearly $4.5 trillion through a series of quantitative easing programs. These massive purchases soaked up government debt and mortgage securities, flooding the financial system with dollars and pinning interest rates near zero. The result was a deep, liquid market where treasuries became the world's collateral of choice, used by banks, pension funds, and governments to settle trades and secure loans. Daily trading volumes often exceeded $600 billion, eclipsing any other bond market. An ex-Federal Reserve advisor, reflecting on those years, described treasuries as the anchor of global finance, a safe harbor in any storm. Regulations passed after the crisis, like Dodd-Frank and Basel III, reinforced this status. Banks were required to hold more treasuries, treating them as risk-free assets for capital calculations. The liquidity premium, the ability to buy or sell at any moment without moving prices, became a defining feature. Even as the national debt climbed, the world's appetite for U.S. debt seemed insatiable. The dollar's reserve currency status, the scale of the American economy, and the perceived stability of its political system made treasuries the backbone of global portfolios. This foundation of confidence created a system where foreign central banks, sovereign wealth funds, and international investors could always find a buyer or seller. The U.S. could borrow at lower rates than any other nation, financing deficits with little immediate consequence. But this comfort came with a hidden cost: a growing dependency on continuous demand, both from foreign investors and from the financial institutions that underpin the market's daily operations. As the debt expanded and the Federal Reserve's role deepened, the sense of safety grew, but so did the system's exposure to any change in global sentiment. Every week, the U.S. Treasury holds auctions to raise cash for government spending. For years, foreign central banks, especially China and Japan, were reliable buyers, soaking up large portions of new debt. But that pattern is changing. China, once the largest foreign creditor, has trimmed its treasury holdings to around $850 billion, down sharply from its peak. Japan, facing its own economic pressures, has also moderated purchases. As foreign demand slips, the burden shifts to a small circle of institutions, just 23 primary dealers, including the biggest names on Wall Street. These firms are contractually obligated to buy whatever is not claimed at auction, but their balance sheets have limits. A former Treasury debt official describes the pressure as relentless. When foreign bids shrink, primary dealers must step in, absorbing billions in new supply. But post-crisis regulations, like the supplementary leverage ratio, mean dealers cannot expand their holdings indefinitely. During periods of stress, their capital buffers tighten, and the risk of being stuck with unwanted inventory grows. A veteran bond portfolio manager explains that when auctions go poorly, yields can jump in a matter of hours. Wider bid-ask spreads and thinner order books signal that the market's plumbing is under strain. This is not just a technical problem. Every percentage point increase in Treasury yields raises the government's annual interest bill by about $80 billion. If yields climb by 2 percentage points, net interest costs surge by $160 billion almost immediately. For a government already spending over $800 billion a year on interest, the math gets punishing fast. Dealers warn that repeated auction stress could force the Treasury to pay higher rates on trillions of dollars in new and maturing debt, compounding the fiscal squeeze. The link between auction mechanics and the federal budget is direct. As primary dealers strain to absorb excess supply, the cost of borrowing rises for everyone: taxpayers, homeowners, and businesses alike. The ripple effects begin in the bond market, but they do not stay there for long. The dollar's strength has long shielded American households from the full cost of living in a global economy. But when confidence in U.S. debt falters, the effects reach far beyond Wall Street. Nearly 15% of the nation's economic output, about $2.5 trillion each year, comes from imported goods. From electronics and clothing to fuel and food, daily life depends on a steady flow of products priced in foreign currencies. When the dollar weakens, every container ship docking at U.S. ports brings goods that cost more in dollar terms. Economists have measured the impact. A sustained 10% drop in the dollar's value typically raises import prices by 3 to 5% within months. That effect does not stay in warehouses. Retailers and manufacturers, squeezed by higher costs for everything from semiconductors to sneakers, pass those increases along. For a country where imports account for 1/4 of all consumer spending, even small changes in currency value ripple quickly through store shelves and utility bills. Energy is especially sensitive. Oil and natural gas are traded globally in dollars, but when the greenback slides, American buyers must pay more to compete with foreign demand. The same logic applies to raw materials, metals, chemicals, and parts that fuel the country's factories. As the dollar loses ground, the price of filling a tank or building a home inches higher. The result is a feedback loop. Higher import costs push up inflation, which eats into paychecks and raises the cost of borrowing. The Federal Reserve may respond with higher interest rates to contain inflation, but that makes mortgages, car loans, and credit card debt more expensive. What began as a shift in global confidence now lands as a higher grocery bill, a pricier commute, and tighter household budgets. The connection between distant bond markets and the family dinner table becomes unmistakable. A sovereign debt crisis rarely unfolds in isolation. When confidence breaks, the consequences ripple through every layer of an economy. History offers a grim checklist. Foreign investors pull back, borrowing costs spiral, the currency drops, and inflation surges. As panic spreads, banks tighten lending, pension funds take losses, and households watch their savings erode. If policymakers cannot restore trust, the government may be forced to seek outside help, accepting strict conditions in exchange for emergency loans. The social fabric strains under the weight of unemployment, wage declines, and public unrest. These stages have played out in countries from Latin America to Eastern Europe, each time leaving deep scars. For the United States, the stakes are even higher. Economic vulnerability feeds directly into strategic risk. Nowhere is this clearer than in the supply of critical minerals. A supply chain analyst explains that the United States imports about 85% of its rare earth elements, materials essential for everything from missile guidance systems to electric vehicle batteries. Nearly 70% of global rare earth processing takes place in China, giving Beijing leverage over the entire value chain. Tungsten, another vital input for defense and high-tech manufacturing, is no different. The United States relies on imports for roughly 70% of its needs, with China, Russia, and Vietnam as the main suppliers. Building a secure domestic supply is not quick or cheap. New mines and processing plants face years of permitting and regulatory review. Estimates suggest it would take 7 to 10 years and between $10 and $20 billion to cut import reliance by half. Until then, any disruption, whether from trade disputes, export controls, or a weakening dollar, could threaten industries at the core of national security. In a world where financial instability and geopolitical rivalry collide, the line between economic crisis and strategic vulnerability grows thin. The consequences of losing investor confidence extend far beyond the bond market, exposing critical weaknesses that cannot be fixed overnight. Every second, the U.S. borrows nearly $69,000 to keep its promises. As foreign confidence wavers, the cost of doubt grows. Global stability still hinges on trust in the dollar, but trust, once fractured, is hard to rebuild. The system endures until the world decides it won't.